Hi there. We're well on our way on managerial accounting to understand how the cost functions flow. We're going to be talking about break-even analysis. We'll be talking about materials, labor, and overhead costs. And we are going to be examining what it takes to not only break even, but to make a profit. So let's start by taking a look at some of the concepts associated with this CVP, this cost, volume, profit analysis we're looking at. We're going to start off with the relationships between revenues, costs, and we know what the revenues minus expenses yield are profits. So we need to understand through profitability impacts of things like the selling price. Obviously, if you sell more per unit on a dollar cost, the actual results are going to be hopefully higher profits. But we want to be understanding of the cost drivers behind that. Now we'll be talking about variable costs and fixed costs. So the CVP analysis, and I'll read it right here, technique to examine the relationship among volume to an independent variable, total costs, total revenues, and profits for a specific period of time. So we understand that flow and what it looks like and where it's going to put us. So why use it? Well, for profit companies, we need to ask questions and how much do we want to make or how much can we make based on what we sell and the cost structure behind it. So if our selling prices are increased by 10% and fixed costs increase by 8%, do we make more money or less? Fair question. How about nonprofits? Homeless people, how many can we house with a budget of 400 grand? Or how much money can be raised from alumni to provide 50 scholarships? So we might have targeted goals, but we're asking the questions and the relationships. So let's get a little bit fancy. We have some formulas to deal with. The first one is profit, and profit equals revenues minus expenses, or total revenues minus total costs. So we got a profit factor here. We have revenues are defined as a function of sales of units. So we're taking a selling price times that number of units. There's our revenue. And then our costs are divided into two major categories. We have our variable costs and our fixed costs. The fixed costs indicated here by A is a fixed price or a fixed unit, a fixed dollar amount rather, where the variable costs are based on the cost per unit times the number of units. And that might be materials, labor, and we'll associate that. And so the big picture is profits equals the revenue, the price per unit times the number of units, minus the fixed cost, A, plus the variable cost, which is the variable cost per unit times the number of units. And that's how we're going to establish and predict profits. If we go a little further on this and we look and decide, well, what are these assumptions that are behind this cost, volume, profit analysis? Well, first of all, we're classifying all cost as fixed or variable. And the total cost function, we are assuming, again, assumptions, to be linear within what's called a relevant range. And we've talked about that relevant range before. We have a machine that has a capacity of 10,000 units. If we need to make 20,000 units, we probably have to buy another machine. So that's beyond the relevant range associated with that factor. The total revenue function is also linear within that same relevant range. Analysis is for a single product or sales mix with multiple products where the mix is constant. We might have a 30-70 split on if we had two products, or maybe three products, or four. A restaurant may be selling entrees, may be selling desserts, and also may have appetizers, and may have beverages. So those are different kinds of products and the different mix to be associated. One activity cost driver, we're looking at sales per unit, and that sales volume is based on that. And again, our total cost, we said number one was fixed and variable, but we have materials, labor, and overhead are the three broad categories we're going to be focusing in on. So first step, let's look at variable costs, okay? And we'll start with direct materials and direct labor. So if we're making a sofa or a couch, we're going to have leather or vinyl to cover it. We're going to have wood to frame it. We're going to have nails to pop in there and feet on the bottoms to whatever they may be going. And these are all materials. Then we have the labor to assemble it. And maybe each couch takes 4 hours of 4 man hours or person hours to assemble that. We go a little bit further on variable costs. We have overhead. We talked about materials just now. We talked about labor. And then we have variable manufacturing overhead and variable selling and admin costs. And again, these are variable, can be indicated on a cost per unit. So we can allocate overhead per unit. We can allocate administrative costs per unit as well. And there is the fixed portion of fixed manufacturing overhead and fixed selling administrative costs. So if we produce 0 units, we're going to still have costs in facilities. We're still going to have property taxes. We're still going to have equipment that's paid for and needs to be factored in as far as the costs go. And finally, on this section, we've got the cost equation. We have our variable costs. Let's say this is for ice cream bars. Direct materials per unit, direct labor per unit, manufacturing overhead per unit, and we have selling and administrative costs per unit. By the way, these all can be added to inventory. We actually add labor and overhead to inventory. Say, wait a minute, inventory, isn't that an asset? And if I'm Best Buy, I got washing machines and dryers, refrigerators. But I also, when I track that, if I'm a manufacturer, I can build in my labor and overhead as part of that inventoriable costs. Feels kind of strange inventorying labor, but that's exactly what we do. Then we have the fixed cost. We do have a fixed portion of overhead and a selling and administrative fixed cost. And those are gross amounts. Those are not per unit amounts. And so the profit formula, we have the revenues. We have basically, we'll be talking about break even in a few minutes, but a profit formula are $1,000. We have our revenues minus our variable costs minus our fixed costs. And that's the target in a nice algebraic formula when we're looking at that. Let's go ahead and talk about the old-fashioned income statement. We've looked at income statements before. We have revenues less cost of goods sold is a gross profit margin. We have other expenses, variable and fixed, and then we have a net profit bottom line that goes around with our income statement based on, this is a projection of $69.50 ice cream bars for $1,000 in profit. But we want to look at a CVP income statement. So we're going to go one step further. It's called a contribution income statement or CVP income statement. We have sales less our cost of goods sold, but specifically we're isolating the variable costs and yielding the term what's called a contribution margin. You want to know that term. The contribution margin is your revenues less your variable. And then we deduct our fixed costs. And then we have our profit. You say, wait a minute, $1,000 looks familiar. And sure enough, we have the same profit. It's just a little bit different ordering of things. And instead of having a gross profit, we have a contribution margin. But that's because we're deducting the variable costs and accessing that. So here's a contribution margin example. Profit per unit. The contribution is our variable costs associated, and we're deducting our revenues less our variable costs. So our contribution margin, in this case 40 cents per unit, that's what we have actually to contribute to recover towards our fixed costs. And a sensitivity analysis, if you have higher fixed costs and potentially lower variable costs, you have the ability to, with higher volumes, make a whole much more money. Because variable, it doesn't cost you much more to make additional units, but you've got a big production facility and a lot of machinery and equipment. That's a heavy investment that you've made. So you have a higher risk of loss if you don't have the sales, but for each additional sales, you make more monies per unit when you sell. And I'm going to talk about I'll talk about one other thing when we get started in the next section, when we actually start into break even and cost volume profit. But that concludes this introduction to CVP analysis. So this should get us going and help us understand where we're headed and what we're trying to do. See you soon.